perhaps what I can do is just share a little bit of my background, and then I think helpful to hear a bit of your all's background, just in terms of where you are in that type of fundraising process. And then if your entity that you would be fundraising for is a for-profit or not-for-profit, because I think that also sort of varies how I talk about this. So Nneka Eze is my name, based in Lagos, Nigeria. I have been here for the last 9+ years. And then prior to that was in Senegal and in Kenya. Born and raised in the US, as you can probably tell from my accent, and had a chance to, work across a number of different countries on the continent, and a couple in Asia and in the Americas as well. I joined the Resolution Project Board a few years back, and it's been great just to hear all the news from the fellows and participate in some of the social venture competitions as well. I invest in early stage companies in East and West Africa, generally from what we call the seed stage, and we'll get into that, all the way through to Series A or Series A plus. It's really just different rounds of funding as a company goes through its growth stage, and have been investing as an angel investor, and then now as a investor probably over the last 8 years or so, but joined Vested Worlds 2.5 years ago as a general partner and managing partner, and was previously at a firm called Dahlberg for almost 12 years, helping build the Africa business. And so definitely have a lot of exposure to fundraising for both nonprofit and for-profit entities, and happy to talk through that. Wondering if you guys can maybe do quick intro, quick intros, just so I know a sense of like where you are in this fundraising process. Is it new to you, or you've had some experience, as well as for-profit versus not-for-profit?
I could start. Hi, everyone. My name is Wendell Mtiane. I run a startup called Grind Tea. So this is my first round of fundraising. So it's a for-profit startup that helps women and people of color find workplaces where they are valued.
I can go next. Hi, everyone. My name is Abhinav Kanal. You can call me Abhi. I'm the founder of, or co-founder of Bean Voyage, which is a nonprofit social enterprise that works with smallholder women coffee farmers, mostly in Latin America. And we're a nonprofit, and so most of our funding comes from grants and subsidies. We've been around for a little bit over 5 years now, and so interestingly, there isn't a stage for nonprofits, which is kind of weird because there isn't like a pre-seed or Series A or anything of that sort. So I don't know where we would categorize ourselves in, but we've definitely worked with like family foundations, corporations, and a few government entities to receive funding. Yeah, happy to be here. Excited for the conversation.
I think I'll go next. My name is Alicia Mbalire Namakula. I am a co-founder of Women Income Network in Uganda, and we work towards empowering women in rural communities to become good farmers as a way of boosting their economic mobility, but also ensuring that they are at the forefront of bio-waste management, proper bio-waste management, and providing food security through this technology. And where are we at as an organization? I think, I think we have raised some seed funding, first through the Resolution Project and Echoing Green, and also we have explored consultancy as an alternative revenue stream for organizations. So we have worked with Open Data Institute and any other local partners who wanted to set up demonstration farms. So excited to learn more and explore this journey with you all. Thank you.
We're just going around quick intro so I get a sense of where people are on their journey. But feel free to also type it if you're feeling a bit shy, instead of sharing on the line.
Hello. I think I can go next. I am Martini Jennifer from Uganda. I'm a co-founder of Women Income Network. I think I'm not going to explain more since my other co-founder Alicia has already talked about what we do and so far journey of fundraising. So basically, that's what we do, not repeat much more to make a lot of monotonous. Thank you.
Greetings. Hi, everyone. Hi, NECA. Thank you for joining. My name is Brendan Wong. I'm the founder of Capnos. We create flavored pressurized air inhalers to help address the oral fixations and helping people quit vaping or smoking. We are a for-profit company that started making significant revenues last year in January. And we've had a friends and family round last July that has allowed us to have over 18 months of runway. Currently preparing for a Kickstarter launch as we're launching a new premium product line and looking forward to a possible pre-seed or additional funding round toward Q1 of next year. Thanks.
I think that's almost everyone. I'm just trying to flip through. I think there's probably a few people, but I think I have a sense that it's a pretty diverse class, if you will, who's here. So I'll try to comment in different ways. I think really just covering a few different areas. One is just getting you a quick intro. I think some of you already will have a lot of this terminology in terms of different options and the type of information you might include from a background information perspective, and then how you can think about forecasting. We'll see, how far we can get into things. I think one of the big questions is really like, how are you thinking about fundraising and what do the different stakeholders expect when you're looking at fundraising? In a way, if you're a few years into your journey, there's going to be a much higher level of expectation than if you're much earlier in your journey. And we see that often, for me, obviously, in venture capital or in prior work where I was, helping to set up new initiatives. If you're starting from scratch, in a way, it's a bit easier because you're really putting on paper what your dreams and your visions are. Once you have a couple of years of operations under your belt, oftentimes stakeholders will then expect you to have some level of financial history as well as financial projections to really show the way of what's coming. And so it's just helpful to understand like where you are in that path. Are you like in year 1 or year 2, or are you in year 7? It's a very different level of expectation for sure. And then also, who are you going to be fundraising from? So is it through grant applications, or is it through cold outreach? Is it through warm introductions? And I tend to find that warm introductions are almost always preferred. And for some reason, both with foundations that we've been fundraising from or with individuals, it's much easier and higher quote unquote hit rate, meaning somebody will reply to you if maybe their friend or a friend of a friend even makes an introduction, versus if you're reaching out completely blind without any kind of introduction. And I think in a way the Resolution Project Network can really help with that. I think one of the things that I was mentioning here is really this question about like, where are you on the journey? What kind of capital you really need? And what are the objectives of the people you're reaching out to? So you might have, if you're looking at more of like a nonprofit social venture, there may be grants that are repayable or very, very low interest debt. And that might even get written off if you meet certain impact objectives. And there also may be some objectives around the profitability or the unit economics of the program that you're delivering. So if you're selling products or services within your nonprofit, there may still be an expectation that there's going to be some level of profitability that can help sustain the enterprise. And then definitely if you're looking from a for-profit perspective, the profit objectives will still come into play, although you may also find investors who are looking at impact. What I'm finding more and more is that there are what I call returns first impact investors, who are really investing in for-profit companies that are really going to have a top tier financial return while also having deep amounts of impact. And that's sort of more where my fund would sit, for example. And then you also have a number of, I'd say primarily foundations and family offices who might consider a returns first impact investing an impact first impact investing objective, where they actually are saying we want to have the greatest amount of impact, and the financial returns, while important, are not going to necessarily hit the quote unquote market rate of return. And it is important to understand like what is motivating the potential investor or funder that you're talking to, and that way you can tailor your pitch to that. So one example, a few of our companies are raising different rounds of funding, and as they're talking to investors, some of them might be, for example, a fast-moving consumer good company, or it might be a Japanese pharmaceutical company, and the pitch to them is very different than, for example, when they're pitching the United Nations Development Program for grant funding and being part of a program. And so the way they will sort of talk about not so much the work, but sort of the way they maybe prioritize or put up front in the story, emphasize in their story certain aspects of their business may be very different in those two conversations. I'm going to just maybe pause here before we move on to types of funding, so I can just maybe see your faces if you are still with your faces, and yeah, see if there's any questions. No worries if you're not on camera, it's fine, but I'm just pausing my own screen so I can look at you guys. Any questions so far in terms of like objectives and how to think about positioning your organizations for different audiences? Feel free to just go off of mute if so, because I don't think I can see everyone on one screen. All right, well, feel free to chime in. I'm going to keep going, and we'll see how it goes. So we're just going to quick walk through. I think you guys, many of you will have exposure to some of this already, so I don't want it to be sort of too early on. But there are a range of different, what we'll call for-profit funding sources, and that can come in the form of equity. And this is really where somebody will end up, or an entity will end up owning a percent of your business. There's different structures and types of equity that you can give out in your business, but it really means that somebody is going to own a percentage share of your company, and essentially have access to returns from that company, or if that company is sold, they would be able to participate in some of the upside from that sale. And there's debt options, and some of them need a security. So this would mean some sort of asset that is backing the loan, or they could be unsecured. And that means that they're really just based off of the business itself, the business performance. And some providers can actually do both. Some can only do one. Some can do other structures within either of those. I'm happy to talk through those. And then, of course, you know, one of the big questions with for-profit type of investors is how are we going to make the money back for our own investors? And that could be for a family or an individual, or it could be, in my case, for example, for my investors, and obviously for myself as well. But I think there's a question about, if we invest this money in your business versus anybody else's business, are we likely to see some sort of return? And then also, for that return to happen, who is likely to buy into the business in terms of an exit? Or is the business going to generate so much cash that it's going to be able to pay us back in something called dividends, which are essentially a percent payout based on the profit of the company? And then I think part of this also depends on the market that you're in as well. So I'd say market, sector, and stage. So if you're a completely new, innovative idea in an emerging market, it might be a bit more challenging to attract certain types of capital than if you're in a market where maybe there's a lot of different capital providers who've done this before, who've seen an exit path and see a way that you can also move forward. And so again, the way you tell your story may have to call on some of those past examples or explain why you're going to make it in a market where maybe there are fewer examples. So I think it's just, again, something to keep in mind for the for-profit investors is how they're going to make the money back and how they're going to really exit from the business in order to do so. And then, yes, there's definitely an impact component that can come into play, but I would say it's definitely helpful to understand that as you're engaging with investors and depending on the type of capital you want. So there are going to be some for-profit investors who are looking at, okay, we want to exit within 1 to 4 years, and others that will be more like 5 to 9 years in terms of when they actually plan for some sort of an exit. That depends on the type of funds that they have, the type of expectations of their investors, as well as the type of capital that they're looking at. On the not-for-profit side, I think many of you will be familiar with this, partly because you're all Resolution Fellows, so you've understood a bit some of the expectations around grants or donations. Those could come from foundations, corporations, other nonprofits, or from individuals. And I think there it usually is a question of what's the impact potential for sustainability, and I think as well potential for scale. So I think somebody had mentioned Echoing Green, for example. One of their big questions is like, how can the enterprises that become part of the Echoing Green community get to that next level of scale and really have massive impacts? I think the other one is there are going to be some entities that are very specific on the type of things that they can fund, even within your organization. So they might only allow you to fund staffing costs, or they might only allow you to invest in like capital. So this might be machinery or equipment, rather than necessarily an organization-wide grant that allows you a bit more flexibility. So I think those are just important to keep in mind as you think about the type of funders that you would be talking to. And then definitely there's always going to be mixes of different kinds, and even we call it in venture a funding round. You could imagine you could have multiple investors in the same time frame of funding, and that's called a funding round, that could have different expectations. And I think the question is more, can they all see a way to invest together into your enterprise? And so that could end up being that maybe you have one investor that's completely profit motivated and one that's impact oriented, and you have to see how they can sort of meet together to come up with terms that they're both comfortable with. Or you could see one saying, okay, you're accessing debt at this rate, we're going to help you essentially buy down the interest rate based on the impact that you're having. So we've definitely seen some of these hybrid funding forms. There's also like guarantee facilities as you all get to like the next level of scale as well, where you have usually a either a nonprofit or a government agency or entity who provides some sort of guarantee facility to help you unlock debt capital, let's say with a commercial bank. Sometimes they do a guarantee structure. Other times these entities actually give cash that's held at the bank to unlock financing for you. So there's a range of different options that exist in terms of what this hybrid might look like. And I'm sure we can get more into that as well. I'm going to just shift over to now like what actually you might look to put in your financial background as you think about fundraising. And then we can talk a bit about like maybe some of the storytelling and some of the challenges that happen as well. I think one of the biggest thing is we do all want to understand like where you're coming from. Oh yeah, do we have a question? Yeah, go ahead.
Nneka, I to interrupt you a bit, mostly on the slide of non-profit organizations, where you stated that one of the key contributors is showing how you're measuring impact and also how you're planning on being sustainable. Now, that is the biggest question of how to show my sustainability as a non-profit organization, because sometimes I feel like the way to show it, like the way we have created a model to show our sustainability as Women Income Network would make us sound like we're a hybrid organization. So I'm wondering, how do you show sustainability as a non-profit organization without calling out yourself as being a hybrid organization? Am I clear?
I mean, I think in these days, in a way, there is a question about how to be. I've not heard of hybrid before, but I think it's not so much about your organization. This is more about the funding sources in terms of the hybrid versus not-for-profit versus for-profit. This is about the funder itself rather than the recipient of the funding or the investee. And so I think as a not-for-profit, very much there can be an expectation, especially if you're looking at being a social enterprise and really thinking about exploring impact investing, that over time, the initial investments are really going to unlock the ability of this organization to continue and sustain itself, because there's demand in the communities that it's working in, and there's a business model that actually makes sense. And so the revenues, if we will, from that nonprofit entity can maintain its operations. And I think there's definitely an understanding of that in different funding circles. And so I don't think you should be too concerned about sharing how your, we'll call it a business model or operating model, can help with the sustainability. I think there's been a lot of macroeconomic challenges in the for-profit landscape as well as the not-for-profit landscape in terms of fundraising over the past few years, given like COVID, markets, all of it, recessions, inflation, so many things are affecting both your enterprises, investors, and funders. And so I think being able to show that we are going to be able to get to sustainability with your dollars or shillings or naira or whatever currency is pretty impressive in this day and age. And I think maybe it's a shift from some older nonprofit models that really did require donor funding into perpetuity. And so I think it's a question of which model that you're really pursuing with your nonprofit and how do you tell that story more so than that funders are going to think that you're a business. That being said, we've seen nonprofits that become for-profits over time. And I don't think that's necessarily a bad thing. What they often end up doing is that the not-for-profit actually owns a significant shareholding in the for-profit. And so it sort of helps to keep it mission aligned. So there's definitely different ways you can think about that in the longer term trajectory of your not-for-profit. But I think finding ways to maintain the impact that you're having while also being sustainable are really important, especially in this funding environment. Hopefully that was helpful. I'm gonna keep going, but feel free to, yeah, go ahead, somebody else's, maybe. All right, well, I will keep going. Yeah, so on the financial background, this is really this question about like, what do we look for as we're really understanding Venture's financial journey and the type of statements and things that we would actually be asking for in that process. We'll then talk a little bit about how you actually present this information, but it's important to have this information before you start these type of conversations, even if on the first conversation, you're not sharing everything. So the historical financials, and this is what I was referencing when I was saying, okay, if you're in year 0, essentially year 1 of your journey, it's very different than if you're in year 7 or 8 or 9 or 10. But definitely you'll want to at least have a sense of what are those revenues, if you will, coming in. And that could be from donations, from any sales that you're doing. What are the costs that are going out? And that's really looking at the income statement. Then you want to understand the balance sheet as well. And that's really starting to understand your different assets and liabilities, and then the cash flow statement. And this is really how you're managing the cash in and out of your business on a monthly, quarterly, or annual basis. And obviously, the level of complexity increases as your organization scale and grow. So if your budget is $10,000 per year, that's a very different level of sort of lines in your various financials than I assume in an entity where your budget is $500,000 or $1 million per year. So part of this also depends on where you are in the financial journey. But I think it's important from early on to really start capturing these financial aspects, so that when you get to a point where you're fundraising from larger sources of capital who are perhaps more stringent or strict about the requirements, you have those already in place. For for-profit entities, especially once you're after about 3 years in operations, as an investor, we definitely like to see audited financials. For us, we don't require like a top tier, what they call, big 5 or big 3 accounting firm to do that. But some investors over time will put it as a requirement of their investment that you bring in that type of top tier accounting support to give comfort on the financials that they're seeing, and also to ensure there are no issues in the company itself. So I think it's really helpful to start that early on and just continue that process of having clear financials that anyone can look at and say, okay, we understand how this entity has grown over time, and years where it was much more challenging, years where they've really gone on to scale. And then there's a few pieces around, how much has been invested in the company, how are you actually going to fund your operations, and at what point are you able to get to that sort of sustainability and no longer need injections of capital. And so that's really, in the venture language, it's this question of the path to profitability. And what that really means is, at what point are you bringing in enough revenue that you're no longer needing to fundraise from outside sources, but actually the business model itself is actually funding all of your costs. And so you could sort of maintain that level of growth. And then, of course, if you wanted to scale, you could either do that from the excess cash, or you could do that from additional outside investment. But it's really this question about sustainability and how many years of funding, if you will, do you need in order to get there. I think for the for-profit entities, it's become even more important part of the conversation, just given a lot of funding pullback for equity and even debt investors in recent years. And then I think similarly on the not-for-profit side of things, there is a question over time that might be asked from even your most active donors. So let's say 6 years in, you've been getting like a constant inflow of capital from 1 or 2 donors. They're going to ask themselves, is this going to be forever that we're going to be funding this entity? Or is there a path to sustainability where they might be able to like exit? And by exit, it's really more like stop financially supporting the organization. But I think in general, this question is being asked. And I think the hope is that the impact being demonstrated and the product or service being offered is going to generate some amount of revenue or income that allows the enterprise to be sustainable, or perhaps that allows a government agency to take over the program and offer it itself and sort of lead to massive scale. There's a range of different like exit pathways that exist, but I think the main question going to be asked is like, what is that exit pathway, whether that's a not-for-profit or for-profit. And this piece is really on the storytelling and this question of the way forward. So you have all your historical financial information, and now there's a question about like, how do you actually look into the future of your company or your business? And it's, I think, the hardest one and the hardest part of the whole fundraising process, in my view, is aligning with your funders and investors on that path forward. So that's either saying, okay, how much money do you actually need to scale? How much time do you need to scale? And what's the right model that makes sense? So maybe you have 3 different services that you've done over time, and you really now want to focus on one of them. So you need to find investors or funders who are really excited about that path forward. Because if you have folks who really like the other 2, they're going to push you to go that other path. And then similarly, if you have investors who have a shorter time frame in mind, then you might need to, think about the timing for your growth plans and for your forecasts. And so it's usually a conversation, I'd say, especially for those most interested funders or investors. But it's really important for you to have a clear strategy and sort of target and plan, because you could end up being swayed one way or another. Because obviously, if somebody's coming with funding, sometimes it can be hard to say no, or hard to say, okay, this isn't the right fit. But I think it is really critical to know what it is that you need and want and why, and have a clear plan on that. And then, yes, have the conversations and be open to inputs, but only where they make sense with your experience, because you guys will be the experts in your entities. I think the other piece, this one in the purple, is really around the is your future growth path in line with where your funders want you to go and where they maybe need you to go for their own objectives. So if somebody is trying to create, I don't know, 10 million jobs in Nigeria by 2030, and your entity is going to help them with that because you've already created 1,000 jobs, and you're telling them, okay, this is your path to creating 15,000 jobs or 10,000 jobs. And they would maybe be able to understand how investing in your entity would help them on that journey. But if you're like, okay, we've created 300 jobs and we're going to create 1,000, they might not be as excited about that. But another investor who maybe has other objectives may be interested in that. And so I think part of it is not to try to be like for everybody, but really understand who are the funders that you should be targeting based on what your likely return and impact outcomes are going to be over the period of time into the future. And then I think the other piece is, ideally, some of this type of forecasting you've already been doing in your organization. And so it's not that you're going to change your forecasting for a specific type of raise or funder, but really that it's almost like getting more and more comfortable with where you're going. I think in venture capital, which is more on the for-profit side of funding, there is unfortunately a push to go for 10 and 20 and 100x kind of growth rates, which may not be feasible or realistic. And so sometimes it is this balance of like, here's my best case scenario, and maybe here's a more. Hello? Mary, I think it is. Did you have a question?
No, sorry. That was a
Okay.
mistake.
No worries. Just gonna mute you. So yeah, I think if there's just a question about like, how do you balance the industry expectations with what you've seen over time? And then I've also found for some of the companies we invest in, I'd say the first 5 to even 9 years is really just building out the concept. Then you're onto something, and now it's time to demonstrate that massive scale. I've seen some companies will now say, okay, we're going to raise $10 million. And to date, they've only raised maybe $100,000. And that can be also challenging because there's going to be a question from the investors of, okay, what are you going to do with this money? Do you know how to manage that big influx of money in your entity? And so there's also a question of like, how do you balance your scale expectations with the funding availability as well? So this is why it says it's more of an art than a science in terms of forecasting. But I found what can be most helpful is actually talking to others who've gone on this journey. So I think that the network of fellows who've already done fundraising, who've already been successful in that, are going to be almost like your best allies in terms of how to balance like a very aggressive forecast with the market dynamics as well as with where your entity is now. I'm going to just quickly talk through, I mean, I think for all of these, I've sort of started to mention a little bit, but I think the main thing is where is the various sources of capital coming from and how are you going to use the capital that's coming into your business? It's usually one of the things you'll want to understand as you're fundraising. So you'll usually see a slide that has, 30% for salaries and specifically hiring, a program manager or a chief, technology officer, or you'll see something around, okay, we need to import these inputs for our agro-processing machinery, and we need to do training for 3 of our staff on XYZ thing. But you'll really break down where the capital is likely to come from. And for some, it could just be we're raising, $50,000 and here's how we plan to use it. And for others, it could be our entity is already generating $20,000 per year in profits. And so we're going to use that every year alongside $30,000 in maybe a debt facility that will cover us over the course of this period of time. But either it's like the headline of how much you're raising, or it's also how you're actually using that capital. And definitely how you're going to use the capital that you're raising. And then in terms of the forecasting, I think this is what I was getting to around the meaningful and measurable assumptions, is really this question about you have some historical numbers, you have a vision for the way forward. How do you get everyone on board with the assumptions that you're making about the growth? So let's say right now you're operating only out of 1 location. And now in your projections by next year, you're like, we're going to be in 20 locations. I think unless you have already done the research and you've identified the locations, you have staff members from those different areas who are going to help with the expansion, it can be really challenging for a funder to believe, if you will, that you're going to be able to, one, just get to a point where you're have staff operating in 20 locations, or even if it's a more online business operating in 20 locations, or that you are able from like an operational perspective to really manage operating in so many locations, especially when you're going from one. So I think part of the assumptions that can drive like a financial model really have to be based on your reality and maybe also based on what you've seen others do. And so this is where I find it really helpful to talk to other fellows, other companies in your same space as well. So let's say you're in water and sanitation and you're in India, and there's a fellow who did a similar project in Mexico and they got to, massive scale. You can talk to them about that growth path and what were the steps that they took to get there. And that way, when you defend, if you will, the assumptions or talk about your assumptions with potential funders, you can talk about why you think this is feasible and what challenges you might actually face. The unit presentation approach, I think it's really just question about, so for each of the different aspects of the revenue drivers, if you will, really understanding what those drivers are. So let's say that you are helping to purify water in a specific location, just to continue with the water and sanitation. You might have different entities that are working with you. So you might have people in certain neighborhoods, and maybe their costs are a bit higher or lower. And you might have certain buyers who have a higher willingness to pay. So if you're serving restaurants, it might be different than if you're serving residential locations with the water. And so you have to sort of build out the units, if you will, of your sales or of your revenue in a way that makes sense. The other one would be, okay, you have 30 individual donors and you're expecting that this will increase to 50. And maybe you have some small donors, medium and large donors. And you'll also have to sort of justify a bit how you're going to get to the 50, and also why maybe you're going to mostly get small donors, because you have this really amazing community-based approach where you're getting, you know, I don't know, the folks who grew up in this neighborhood who are now in another neighborhood to donate to your entity or something like this. But there has to be a clear path to the units that essentially build up to your financial model or your projections. And then the last one I mentioned was around the scenario analysis. And that's really this question of what's the best case that could happen? And that's based on your dreams as well as on your historicals and what you've heard from others. But I think it's always helpful to have like a mid or more conservative case as well, because investors and funders are going to make that as well, to say, okay, let's say your wildest dreams are not possible over the next couple of years. What might it look like? And are we comfortable with the level of impact, returns, revenues that would be suggested by that? And there's a whole other section around like, how do you think about presenting forecasting and thinking about your assumptions and really building models that you can essentially work with and move assumptions around into. But I think it might be helpful to actually sort of pause here and just see if there are any other questions, because I know there's a lot of other things that we could cover in this, but we don't have too much time. So I'd rather maybe I'll just stop my share, and I'd rather just hear from you all, like, what are those questions you have of your fundraising, like now, or that have come up in your fundraising journey, and maybe we can either I answer or others chip in as well to answer those.
Yeah, I have a quick question around sort of what you talked about, like the percentages of where the funding is going to go, 30% towards this, etc. I was putting my model where I had, I don't know, about 50% towards user acquisition and marketing and stuff like that, just based on where we're at and what I thought was important at that time to sort of gain traction. And one of my VC friends was like, well, that might not be ideal, because investors want to see more allocations going towards the technology, and the technology itself should be what then sort of drives the higher uptake of user acquisition and all of these different things, right? So I thought that was interesting. So is there like a rule of thumb around what's important and what they're looking to invest in versus others, etc.?
Yeah, definitely. I think it's also a mark of the times. So in past years, you might have been able to raise a ton of money and spend half on marketing, and then raise more money to spend more on marketing, and maybe have a good product, but not a great product. I think now there's definitely a lot more interest in like product-led growth, where your customers are really the ones who are selling your product for you, where there's some virality that's happening from just having a really good product and having users that are really committed and sticky and it just taking off that way. It's really challenging to spend a ton on marketing. And because, at least from a lot of the marketing we've seen, there's not a direct link between the spend on marketing and customer acquisition. And so you could end up driving up what's called your customer acquisition cost and not really leading to any value that comes from new customers. And so I would say, there's a big pushback, I'd say, on like Facebook ads and Instagram marketing and all of that in the industry, from at least what I've seen, compared to really thinking about who are those partners that we can co-brand with, who are those highly active users that we can get to, give discount codes to for their friends and family and other users that could be similarly sticky. But we're definitely seeing a big pushback on the significant spend on user acquisition. And I think it's probably the same in a way in a nonprofit entity versus a for-profit entity. If you're spending so much on marketing, at least I question the impact side of things. Or is it just for fundraising purposes? But there's obviously a balance. You don't want to spend zero, I would say, but what I've noticed, for example, in Nigeria and Lagos, especially, there's a ton of billboards for new fintech apps. And I'm just like, okay, they raised too much money, I think, because I don't think I've ever started using a financial service. Maybe one. I did try one from a bill, but I think I was just curious. But it's usually someone who texts me like, oh, have you seen this? And they share me a code and then I'll try it out. And if it works, then I'm sold. But yeah, that would be my reflection. Samuel had a question as well. You want to go ahead? And then we can take Taku's as well.
Yes, I think first, thank you so much for your presentation. I think my question is related to the fact that I think it's always hard for us to factor in or how to include operational costs in the budget. And I think, at least from me, that I'm not a nonprofit, sometimes when it's a 30% of the operations, what costs to run the whole thing, people get, oh, it's too much because you should be a nonprofit, you should charge less. So how do you deal with that, or how you go around it? Because it might be a third of the budget, but given circumstances in a country where inflation is ramping and everything, obviously that lowers the operational cost in dollars. But if you want to have the best staff, you need to pay them accordingly. So how do you balance that?
Yeah, I think that is probably the biggest challenge in nonprofits, but also in startups. I have startups that have very high burn rates, and now that's much more challenging because of the fundraising environment. And I have startups that have really low burn rates, and that's like a little bit more easy to manage. But there's a balance in terms of the growth that you can achieve with perhaps a team that's more junior versus maybe a much more senior team. And I think it is to tell the story of why. So part of it, if you have funders who are coming from outside of your market, a large part of what you're doing is actually the storytelling on the problem that you're solving and maybe the how you're solving it. And so it sounds like what you're doing is bringing really top talent to bear on whatever the product, service, solution is. And you have to tell the story about why that's really critical to your ability to deliver on your mission and your vision, and defend that with your numbers as well. And I assume this was not like from the beginning that you came to this decision point, but that you either did research or you had the experience in your organization. And so bringing people on that journey that came to that budget, I think is really helpful to help to justify it, and definitely explaining to them about the macro situation in which you're operating, I would say is the other thing to keep in mind. And at the end of the day, it's all in the demonstration effect. So as you can show the impact and maybe find ways to benchmark yourself to other organizations around almost like impact per operating cost or whatever it is over time. Obviously, early on, it will look not so good, but over time, I think that is really helpful. So they can understand that we know right now our operating costs are high, but we are going to demonstrate that we're going to have greater impact over time. And we're able to show versus these other organizations that maybe have lower operating costs, how we're able to deliver that like greater and outsized impact, and keep that as maybe one of the metrics that you also look at, so that you are aligned with that concern. And but it can also really show and make sure that you're showing that yes, this higher operating cost is also leading to higher outcomes. So that would be my suggestion on how you deal with that. I think
Thank
Taco
you.
is next, then Namakula. Yeah.
All right. Thanks for the time, Nika, and this was really a great presentation. Though I joined sort of halfway through, so apologies for that. And possibly you've already covered what I'm about to ask. So it's really two questions. One that sort of stems off of the last one is, how do you, where exactly do you put the investment for scaling? Because scaling sometimes takes market research, it takes getting experts. For example, for us, we want to scale into more countries. It takes flights, accommodation, meeting with people, being there and finding partners to work with. And that's when you're raising money for a program, for example, is not very interesting, right? So sometimes funders want you to scale, but they don't want you to actually pay for you to get the consultants or folks to help you scale and do it the right way versus just throwing some numbers on a board, right? So that's just my question is, one is, where do you put that investment within your modeling, and how do you think about by what percentage growth do you need to invest to continue to scale? Because if you want one to scale, they have to always invest. And then the second question was, this within my organization, there's a bit of a complexity when you have multiple funders funding multiple programs. And I'm just curious, what's the best practice? Do you create sort of, and what do I mean? Like you can have, let's say, 6 funders funding 3 programs, right? But then you have 3 program budgets. How do you manage how you allocate all of that money across those programs? Is there like a framework that is typically used, or because we've found it very difficult to do all those reconciliations across 6 funders that are given different amounts and different budgets and different line items, and you're just like, oh my God, I can't remember. So just curious on those 2 questions, the investment and scaling, and secondly, how to manage budgets from multiple donors.
Yeah, definitely. I can stay 10 minutes late if needed. I know we started a bit late, so happy to do that. Z, if we still have the line when we get kicked off.
I don't know if we'll be kicked off. I will say, if anyone has any questions, you can email aic@resolutionproject.org. And Michelle and Somali will get in contact with NECA. I also wanted to, before everyone leaves, people are going to be dropping out, if we could get a screenshot of everyone to share with the Resolution team. If you do not want your picture taken, please feel free to go off camera, but we would love if you could come off and we can get a screenshot of everyone for this meeting.
Great.
Oh, and thank you for putting your information in. And thank you for this presentation. This is wonderful.
I'm going to keep talking, doing this screenshot.
Yeah. Go ahead.
Yeah, the scaling one is really tricky, Taku. I think it's a great question. Oftentimes people just have to do the research themselves, like in-house, and sort of make friends by networking with all your fellows and be like, who do I know in this other country that I can talk to and have some free conversations with? Especially where you don't have the funding yet to go and make the case. I think the other option would be like, what's the closest proxy that you can get to by starting to scale nearby, if you will. So maybe one country over and it's like a much cheaper flight, or one city over, whatever that might look like, to get you a sense of like that operational complexity and the additional cost. But I think finding donors or funders who are really going to help you with that scaling cost is going to be ideal. And then also telling them like, we can only get to massive scale if we get to these other countries for this reason, and here's what we need to do it, and be really clear on that, and hope that they can sort of join you on that journey. And then on the other one, I think this is one of the most challenging things, like even for us, like we have over 50 individual investors in our fund. And so you just have to like keep track of them, and birthdays and whatever else. At least our reporting, thankfully, is pretty straightforward in terms of like quarterly and annual reporting and that kind of stuff. So less sort of reporting requirements on that front. But I think over time, there's a question about like, can you find donors that are still mission aligned, but maybe are larger or able to cover a larger percent of your budget? And then 2, for the smaller donors, see if you can align them around the same type of reporting. And we've had that from some of our portfolio companies as well. Perhaps we were the first investor and we had a set of requirements, but now there's 7 other investors along on the journey, and they have to just come to us and say, hey, we can't give you everything you wanted, but here's what we can give you that is within our normal operations, and see if you can align them around a common set of metrics and a common sort of reporting cadence. But that usually comes over time, I would say. So I don't have a good answer for you. I'm sure some of your other fellows have good programs or Excel sheets or software that is not too expensive that could work. But I think part of it is also in the relationship management over time, revisiting some of those expectations and requirements, and also maybe asking for funding to fulfill some of those requirements as well. I think we had one question, but I feel like maybe no longer here.
Ask one in the chat, Nneka.
Yeah, okay, let me scroll up.
So, yeah, I can also ask it too. What value does Vested World provide its portfolio companies who are CPGs beyond just funding? And then also for inventory-based companies who are operating profitably, what are you seeing in terms of trends from seeking inventory or cash financing instead of venture capital nowadays?
Yeah, definitely. I think for us, I mean, we take board seats, and so we help advise our companies on everything from governance to partnerships to strategic investors who can help them scale, and just advice on what we've seen in terms of different companies' journeys, especially where you're like launching new products into market and the time frame that takes to do that. So I think what I've been seeing is it's still really tricky because it's still really early, at least on the continent. I don't have a sense for what it looks like in Latin America, North America, or Asia. So depending on what market you're targeting, I can't recall from your intro, but we are starting to see more of this, especially from private capital sources. So this might be family offices, and this could be just high net worth individuals who are like, oh yeah, we see some cash being generated from this business in a way to fund. But that means it's a bit challenging. You just have to like talk to people and see who's doing this. And then I think still seeing a lot of like private equity activity as you get sort of to the later stages, who want to, own a significant portion of the business. But I would say a lot of private investors are definitely looking at inventory-based and revenue-based financing. And then we are starting to see some venture debt activity as well in consumer. But it's still really early days. I know of maybe 3 or 4 companies on the continent who are really focused on revenue-based financing. And then there's a few that might be looking at some sort of inventory financing, but it's still relatively new products. And then of course, some commercial banks, some are open to this depending on the scale and the type of inventory that you're talking about.
Wonderful. Thanks for sharing.
Great. Well, it's so nice to see all of you all, and please do follow up. I'm much better on WhatsApp, so feel free to reach out, and thanks for taking the time.
Thank you, everyone, and thank you so much, Nneka, for leading this session. We really appreciate it. As a reminder, the next AIC Social Hour is this Thursday at 10 a.m. Eastern Standard Time. Hopefully there will be less technical issues that time around. I apologize again for the start of that. But it was wonderful to have you all. And I hope that you all got the most out of this.
Thanks so much, C. Take care, everyone.